Well, let's start our first conversation for the day. We'll focus on rising inflationary pressure Nigeria is faced with and how this exacerbates the pressure the already fragile economy faces. We had one of the biggest headlines from the quarter coming yesterday, which beats economists. Of course, the forecast of how fast we would see inflation spiking following the move by the Monetary Policy Committee in its July meeting to raise rates as part of measures to rein in inflation. For some, this is almost a predicted outcome where not much will change and there are external elements that are beyond the nation's control, talking about imported inflation and for the fact that the nation remains a heavy consumption base and production is yet to hit the baseline to support any recovery. Now, within the last 24 hours, reactions have trailed the 19.74% spike in the consumer price index for the month of July. We also see the food inflation rate in July recording an almost insignificant decline of 22.02%, reflecting the month-on-month movement of 2.04% from 2.05% recorded in the month of June. Well, joining me now to analyze the inflationary pattern over the course of January to July timeline and the fueling factors responsible for this inflationary spike. And more of this, of course, I'm being joined by Mr. Justin Chukwu, who's the Chief Executive Officer of Cowry Assets Management Limited. He joins me from the United States of America. Thank you so much for your time. Despite the time zone and all of that, you're able to join us. We don't take this for granted. Thank you so much, Mr. Chukwu. It's good to see you.
Thank you, Tolu. It's always my pleasure to join you. How is our country, Nigeria?
Well, we're trying, we're faring, we're still living, we're alive and hopeful. Well, let's get talking. But I always like to start this way. What were you expecting? Because some said, or yesterday I was speaking to Andrew Nevin, and he said specifically that this is really worrisome. I don't know if it also comes to you that way, or were you expecting this sort of hike in inflation figures?
Yeah, Tolu, I was expecting further increase. I didn't expect it to get to 19.64%. I actually thought we would see another 50 basis point increase, but having a more than 100 basis point increase again is actually worrisome. For me, if you recall, I had said at your program that the current measures being put in place by the central bank will not curtail the inflation because it's not addressing the root cause of the inflationary pressures. And if you cast your mind back to where we're coming from, when the monetary policy rate was increased by 150 basis points in May, recall that April inflation was just 16.82%. Then between that time when we increased monetary policy rate by 150 basis points, we subsequently increased again in July by 100 basis points. And yet, June inflation came at a rate of 18.6%. And now we're dealing with inflation rate of 19.64%. So clearly, those policies adopted by the central bank are not addressing the root cause of inflationary pressure and will not necessarily curtail the current inflationary pressure we're witnessing.
It's looking like there is still no synergy, and this remains very important at this time, particularly as we move into an election year. More is coming from the monetary side, and less seems to be coming from the fiscal side. How do we strike a balance here?
Well, let me put it more succinctly. The issue is beyond synergy. The issue is that we need to address the inflationary pressure from its root cause. If you further disaggregate the inflationary pressure, which you did in your introductory statements, food inflation was 22.02%. Food accounts for more than 50% of the consumer basket in determining the all item inflation. And if you take out food inflation, you realize that core inflation was only 16.75%, which means that if food prices had actually moderated, we should be talking about inflation moderating. So the problem we have is issue of food, and we have to look at where is it coming from. Further looking at the food inflationary pressure, you realize items like bread, cereal, tuber are some of the major propellers of the increase in food inflation. Take out those items. Take, for instance, wheat and bread. I mean, bread is a derivative of wheat, and then you have cereals. These are imported items that are imported because Nigeria we're not producing enough food. Today, look at tuber, which is produced locally. and other items that are produced locally. Why is their price going up? Because we have heightened level of insecurity in the country that is constraining food production. If we are to address this security problem in the country, you will realize that food production will improve and there will be food substitution. People will move away from cereals and bread and then eat other locally made food if those food items are cheaper. So that's a major propeller of the food inflation we're witnessing today, and which is a major contributor to the inflation we have. Going further to the core inflation, you look at the issue of energy costs, and particularly the pass-through effect of the depreciation of the local currency. I took a look at what is happening to other African countries that are producing major oil producers. Second to Nigeria is Angola. You realize that inflationary pressure in Angola is moderating. Exchange in Angola has moderated from about 620, 640 kwaza per dollar to just about 420 kwaza per dollar. So which is the pass-through effect of that, we're seeing a moderation in inflation rate in Angola. And Angola is the second largest crude producer in the country. But on the converse the case, because we're not producing enough crude as to enhance our foreign exchange earnings and stabilize our exchange rate. So part of the problem we're facing today in inflation is the pass-through effect of the depreciation of the local currency, which is affecting most of the imported items. So issues are beyond alignment are the fiscal authority doing what they should do? Are we fighting inflation, tugging at the root cause of the current inflationary pressure? Or we think that inflation is driven by money supply only? Yes, there's excess money supply, but central bank has actually withdrawn that through debiting the banks with cash reserve ratios. But beyond that, look at the issues of exchange rate, pass-through effect of exchange rate, cost of inflation driven by food items, and those have to come with addressing the issue of insecurity in the country. If we don't address that, we are running after a horse that has already bolted away.
Well, let me welcome our viewers on DSTV. Yes, we were live broadcast from Rivers State, but now we are back live on all platforms. DSTV, GoTV, so we can continue this discussion, particularly this DSTV channel 418. So let's go on with our discussion, Mr. Johnson. Now, this is worrisome, and the shift in food inflation, even the report reads, it looks so insignificant, saying there's some reduction in some prices of some tubers and all of this. What do you think is responsible for that insignificant reduction in that space?
Well, those could come from lag effect because this is not a harvest, and part of it could come from the seasonal changes coming from harvest periods. I remember this is in the southern part of the country. This is a new yam period, so new yams have come out, and because there is surplus supply of new yam, you could actually understand why the price of tuber may have moderated. So that's a seasonal impact, and like you said, it's inconsequential. But if you look at what overall impact we had on food inflation.
Let's now move on to what we expect the MPC, because the last meeting in July, the governor said it clearly that if this continues, they will continue to also increase rates. If that happens, what do you think will be the impact of that across on the economy?
We should know that continuous increase in rates is we have a definite single outcome, and that we're going to push the economy back to recession. And it's very simple. Your increasing rate has not moderated inflation. It has not led to an increase in food production, as to lead to reduction in food prices. It has not stabilized the exchange rate, as to lead to lower a transmission effect of depreciation of the local currency. It has not enhanced your foreign exchange earnings, as to boost your foreign reserve and help you stabilize your exchange rate. So if you continue to increase in interest rate, what will happen is that you are also pushing further inflation, because the producers will buy money or buy funds from the financial system at higher cost, and they will pass it on to as part of their cost of production, which will further heighten inflation pressure. But that further heightening of inflation pressure will mean that for an average consumer, their standard of living will further deteriorate, because the purchasing power of their income will decline. And then what happens is that their consumption of most items will decline, and producers will no longer have enough demand for their goods. And if they don't have enough demand for their goods, they will slow down their production, they cut back on production, and they will lay off staff. So we are basically working towards a certain shutdown or decline in the level of productive activity in the country. And that's exactly what central bankers are ignoring, that the current approach to fighting the current inflationary pressure will only lead to shut down or slow down economic activities as a result of higher cost of production for manufacturers, lower demand for goods and services, and shut down or slow down in employment. And when that happens, we're going to basically walk into a global recession. And it's only when we achieve that recession that you're going to see a reduction in crude prices, which will begin to reverse the current inflationary pressure. So the approach for me is wrong. The approach should have been, let's look at how do we improve those input factors, those input materials that are driving up inflation pressure. Nigeria is actually a unique case because, one, we can increase crude production like Angola is doing, and therefore enjoying slower inflationary rates, stronger currency. We can do the same thing that Saudi Arabia is doing, which is enjoying inflation rate of just 2.7% per annum. And the reserve is increasing, currency is strengthening. So if we are in the situation where we are now a producing country, we should adopt the approach that producing countries have adopted, and which is why most of the producing countries are smiling to the banks. They're having more stable economy, they're having lower price levels. Russia is a classical example. Russia started the war, but Russia's inflation rate has moderated, interest rates are moderated, and the concerns of the Russian monetary policy managers is we do not want price of Russian export to become too dear to the international community that they no longer import from us. So we need to bring down even our cost of goods as to encourage export of more Russian products. Because inflation has been tamed in those countries as a result of increase in foreign exchange and stable exchange rates. But unfortunately, ours is the reverse. We can address most of these issues by addressing the issue of insecurity in the northern part of the country and addressing crude production in the Niger Delta regions. So for the Monetary Policy Committee, I think they must recognize this, and they must go back to the fiscal authority and say, look, these are problems that are coming from structural defects in the economy. You can no longer continue to fight it, because continuing to fight with higher increase in interest rate will lead to unintended negative consequences.
Now, some of the drivers or inflation drivers, I know we've identified some in your earlier submissions, but I want to focus on 2 or 3 of them. That's transport cost and, of course, logistics challenge, and the big one, the exchange rate depreciation. We've seen what's been happening around these 3 factors, and it seems not to be abating. How do we do it? Some of them are beyond what we can control. We are an importing nation, so we have issues, of course, with FX. Even airlines can't repatriate their funds at the moment. So where do we go from here?
Let's look at the items you mentioned. The issue of pass-through effect of depreciation of the local currency is coming, like I said earlier, it's coming from the fact that we're not earning enough revenue from crude oil exports. And that's also linked to the fact we're not producing enough crude. And that could further be drilled down to the fact that we are having pipelines being breached, we're having shut-in, oil producing companies can no longer just produce and pump products into their pipelines and take them out at the export terminals. I understand the level of reconciliation had dropped to just between 20 and 10%. So in effect, if you pump in 100 liters of crude in a pipeline, you get about 10 to 20 liters at the export terminal. We must address that. That's the core of our problem. And if we do that, we're going to have stronger reserve, stronger currency, and then the impact of even the fact that we are an importing country will moderate. Because once your balance of trade is positive, once you export more than you import, your foreign reserve will improve, and then what happens is that your currency will strengthen. The challenge we have, because we must consume a certain level of goods and services, but we're not exporting further to compensate for that. Then the other issue of supply chain bottlenecks. I'll take it from 2 perspectives. The supply chain bottlenecks associated with importing from China as a result of the lockdown in Guangzhou and some other countries because of China's zero tolerance for COVID has some impact, because China is our largest import market. Of course, you can't whisk away that. So we must live with some element of that. But it wouldn't be that pervasive as to lead to a 19.64% increase in inflation rate. The other aspects of issue of food inflation, we've talked extensively on that. And I believe we as a country should take measure. I mean, today I'm happy to hear that we're fighting back. The government decided to fight back. So it simply means that the government initially decided to hold back against the terrorists and whatever you call them. And now we decided to fight back. And do not think that some right-wing army has the capacity to overwhelm the Nigerian army. I think there's something that is missing. And I'm quite happy. I'm hoping that we've taken the decision now to fight back and restore sanity in our country. If we do that, we're going to see production of food items increase materially. Nigeria eats substantially locally made food. The impact of wheat on bread and other cereals will be moderated if we're producing enough of our locally made food. So the key thing is that the problem we're facing are problems we can largely solve. In terms of energy cost, particularly cost of transportation, of course, that's going to take some time for us to address. The reason is that we're not refining any single liter of crude today in the country. So we must live with imported diesel and the price of diesel. I looked at the website of Nigerian Bureau of Statistics they say a liter of diesel is about 746 naira per liter, and fuel is about 175 naira or so per liter. These are facts we have to live because of our previous decisions not to liberalize or deregulate the downstream sector and allow refineries to come up. So we must live with that for some time until we take the bold decision to address that. So if we're only dealing with logistic issues, which are issue of transportation cost, because if you remember that most of the trucks or articulated vehicles that move goods around drive on diesel, and diesel is deregulated. And like I said, NBS said it's about 746 naira to liter. And even to worsen matters, we don't have other intermodal transport system. The rail systems have been shut down between Kaduna and Abuja. That of Lagos to Ibadan, I understand, had been reduced to 1 or 2 shuttles in a day because of price of diesel. So we're left with only one choice of transporting our goods through trucks, and those trucks drive on diesel, and diesel price is deregulated. So that is an element we must live with. But my position is that if we address the issue of food inflation, which to some extent we moderate if we have food production back to our food producing beds, and we address the issue of insecurity in Nigeria Delta, breach of pipelines, stealing of crude, and we restore crude production to about 2 to 2.3 million barrels a day, we are going to see substantial improvement or reduction in current inflationary pressures.
So as it is, we might continue to see this hike in inflation, that's continued increase. Does this mean anything? Talking about recession, is it inevitable? The global recession, and of course, even in Nigeria, it looks like it's inevitable.
Yeah, well, like I said, if the monetary policies globally, central banks in US, in Europe, continue in the current trajectory, they are going to walk to the global economy into a recession. And that's the only point where the demand for crude will decline, price of crude will decline. So energy costs, which is the major propeller of current inflationary pressure globally, will moderate. The approach for me should have been that the Western countries should begin to retool their refineries and look for alternative crude supply sources. If Nigeria could be encouraged, whatever that encouragement will entail, to improve production, we have the capacity to scale up by about 1 million barrels a day. And remember that Russia is producing about 10 million barrels a day. So if a country like Nigeria can scale up by 1 million barrels a day, get countries like Libya to scale up, and probably if the OPEC countries can improve production by about 5 million barrels a day, crude prices will drop even if the war in Russia and Ukraine continues. And that, for me, is the approach to begin to address the energy cost instead of just increasing interest rates. Increasing interest rates will lead to gradual slowdown in production consumption in Western countries, slowdown in production, retrenchment of workers, and the global economy will go into recession. Of course, Nigeria will not escape it because we're not even addressing the core of our own problem.
Indeed, I must appreciate your time. I've been speaking to Mr. Johnson Chukwu, who's the Chief Executive Officer of Cowry Assets Management Limited. Thank you so much for spending your early hours with us, joining us from the United States of America. We appreciate this.
My pleasure.